Thank you for joining us today. My name is Steve Boblis, and I'm an advisor with the Retirement Group. For those who might not be familiar with us, we are an independent financial advisory firm. For almost 30 years now, we've been helping corporate employees prepare for and then transition into retirement. We're not associated with AT&T or with Fidelity, but we do focus on working with AT&T employees. Because of the knowledge that we have of the pension plan, the options that are available, your 401k, the health benefits, and the other things that are available to you as AT&T employees, we're able to give some specific guidance as you start looking out toward retirement, whether that be soon or even a little bit further down the road. One of the things we use to help with that is a financial analysis. We take a look at what your numbers are. Take a look at your pension, your 401k. We make some projections out into retirement, and it helps us to see where you stand, and it helps you to see where you stand. It allows us to give you some specific advice because of your circumstances, and it allows you to see if you're ready to retire, if you can maintain your retirement lifestyle, or if you're on track to retire. That's still a little ways down the road. Because of the amount of work that we do with AT&T employees, we do that on a complimentary basis, and we'd love to prepare one for you. We're going to be talking today about individuals as they prepare to retire. And typically what happens when someone retires, they take their pension. Now, if you decide to take the annuity or the survivor annuities, any one of those, they'll be paid to you directly. Many folks that we talk to wind up taking the lump sum. They choose that option. And so the lump sum and the money in their 401k is moved into an individual retirement account, an IRA. And then that money is invested and we set up their monthly income. But sometimes a little difficulty can occur when individual leaves when it's perhaps not when they really planned on leaving. Company's been going through some cutbacks for a while and just received notice a little bit ago that some more are going to be coming down the road. So what happens if you're put into a situation where you're, say, 55, 56 years old and you're surplused out? What options do you have? Well, the concern is, of course, because there's a rule that you might be familiar with, the 59.5 rule. And what that rule is that the money that you have in your qualified plans, your pension, if you take the lump sum, your 401k, your IRA, whatever money you have set aside for retirement, you take that money out and it's treated as ordinary income. But if you take that money out prior to 59.5, there's an additional 10% penalty. Well, what if you wind up being in that situation, less than 59.5, and now you have to rely on this money that you have set aside for retirement? Are you stuck with paying that 10% penalty? Well, there's actually a couple of ways that you might be able to navigate that situation. We're going to talk about one of them today, and that's called a 72T. Kind of a funny name, but the reason for the title is that's where it is in the IRS tax code. So what a 72T does is it allows you to take penalty-free withdrawals from your IRA account, still paying the tax, but not paying that 10% penalty tax. There's some stipulations that go along with it. You need to take 5 substantially equal periodic payments. And they do it based on your life expectancy. So there's a calculation that's done using interest rates and your age, your life expectancy, and how much money you can take out of your plan. But when you follow those guidelines, you're able to receive that money, still paying income tax on it, but avoiding the 10% penalty tax. Well, the key to remember, of course, is that you need to take these payments for 5 years or until you're 59.5, whichever is longer. So let's look at a situation where someone would have to do that and how that might look. We'll take Cynthia. She's 52 years old. She has $800,000 between her pension, her 401k, and other IRAs that she has. She needs $42,000 a year to live on to be able to fund her retirement. She rolls this money over to an IRA, and then what she does is she sets up a 72T. Now again, remember we said that the 72T is going to be in place for 5 years or until you turn 59.5, whichever is longer. Because Cynthia is 52 at the time, that's going to be in place for 7.5 years. While that's in place, you can't alter it. You can't take more money, you can't take less money, or it ends the 72T, and now you're stuck with penalties on all the money that you've already taken. So let's show how the dollars work out and why this can be advantageous. On the left side, we have her using a 72T. So over the course of the 7.5 years, she takes out a little over $42,000. Her IRA is valued after this time period, after 7.5 years, at a little over $1 million. Well, the reason it grows is because she's taking out less money than what she's earning, given in this situation. So over the period of time, while she's getting income, her IRA continues to grow. And at the end of the 7.5 years, or when she turns 59.5, it's worth a little over $1 million. She paid almost $119,000 in tax over the 7.5-year period. And now at the end, looking a little forward, at the end of 15 years, her IRA is now worth $1.76 million. The money can continue to grow. Let's compare that to what happens if she did not use a 72T. Well, to do that, to get her income of $42,000 a year, she has to take out more money because there's taxes, additional taxes, penalties to be paid. So she winds up taking out a little over $50,000. Because she's taken out more money, there's not as much left in there to grow. So now at the end of 7.5 years, or when she turns 59.5, now there's only $954,000 in her IRA. She's paid $173,000 in tax. So that's $55,000 of additional tax. More money that's come out of the IRA that has to be paid to cover these penalties. And as a result, at the end of 15 years, a balance of a little over $1.6 million, a difference of $130,000. That's a pretty sizable amount of money. So a 72T can be very advantageous from a financial standpoint if you're in a situation where you're under 59.5 and you need to rely on those qualified monies that you have to take care of your income. Remember though, again, there's some stipulations. There's some things that go along with using a 72T. They're not bad necessarily, but you do need to know what they are and be aware of them so you make sure you can follow the guidelines. It can be set up very easily, but you need to make sure that you're ready to stay on that track. Let's show you how we would set one up then. So let's say you're in this position and you have $400,000. If you're going to set up a 72T, one of the first things we would do is we would split it into two. You notice two IRAs. Why would we do that? Well, keep in mind we mentioned that once you set up the 72T, you can't take more money, you can't take less money, because if you do, it causes a problem with the 72T. It ends it, and now you're forced to pay penalties going all the way back to when you started taking the money out. At the same time, while you're receiving these 72T payments, you could have other things that come up. You might have additional monies that you need for another purpose. Well, once you set up the 72T, you can't take them from that pool of money. So just as a precaution, we would set it up as two different IRAs so that you now have one that you can use as the 72T and the other one that you have available should something else come up. Simply a matter of trying to prepare for the future. So there's different ways to use the 72T or different circumstances, and we'll show you how this might look if under a couple of different scenarios. We're going to look at 4 of them. If you start a 72T and then stop prior to that 5-year or 59.5 age time frame. Second, supplementing your 72T with a second 72T. The third one, what if an emergency comes up and you need to take an IRA withdrawal? And the fourth one, using it to supplement post-55 distributions. We'll look at each one of these. Again, we have our $400,000. We split it into 2. The individual sets up a 72T, takes the payments for a couple of years, and then decides they need more money. So they take more money out, or they don't want to take any money out. Well, you notice the X, the 72T now goes away. During those 2 years, you paid ordinary income tax on that $15,000 each year. But now, because you've ended the 72T prematurely, now the IRS is going to go back and collect that tax on those 2 years. So whereas you already paid some income tax, now you've got a 10% penalty on $30,000 in distributions. So an additional $3,000 in taxes now owed. The next one, Let's say you set up a 72T. We have our example, we break it off, the 250,000, we set up the 72T, and that's working great. But a little bit down the road, circumstances change and you need a little bit more income. Well, we had set aside that other amount, that $150,000 amount. So what we can do is we can set up a second 72T. We break that 150,000 into two, and we develop or put together a 72T. And again, the amount that you can take is not just what you feel like. It's based on your life expectancy and interest rates at the time. So we have to determine how much you need to get the income that you want. So in this situation, you now have a second 72T. Not a problem. You actually can have as many 72Ts as you want. The IRS isn't concerned about that. Each one has its own schedule. That 5 years till 59 and a half, whichever is longer, applies to each one separately. So you have to make sure you stay with the schedule on each. The third option, an emergency comes up. So we broke off our money, we have the 72T set up, you're getting income, and now major car repair, roof on the house, something like that. Well, remember, we set that money aside over in that other IRA, that 150,000. So at that point, you could go to that IRA and you could take out that emergency amount that you needed of $10,000. Again, you'd still pay income tax on it. And in this case, you would pay that 10% penalty tax. But that was the best option you had at the time if this was all the money that you had. The good thing is we still have the 72T set up. That's not hurt. And so you're not paying any penalty tax on those monies. You would pay it on that one-time emergency amount that you had to take out. So ordinary income tax on the 10,000 and an additional $1,000 penalty, but the money's there and available for you. The last one is using it to supplement post-55 distributions. Well, this is a particular case. We won't talk about it today, but it allows you, if you separate from the company in the year that you're 55 or later, to leave money in your 401k and take some distributions from that. So many times that also is a viable way of taking income prior to the time you turn 59 and a half if you wind up leaving the company early. But we can also use a 72T in conjunction with post-55 distributions. So in this example, the person is taking post-55 distributions, which have a little more flexibility to them, but let's say they do need some more fixed income or they're running out of money in the 401k. We can set up a 72T. You can do that in addition to taking the post-55 distributions. So what it tells us is there's different ways to use a 72T or different circumstances where it might fit. The good thing for you to know, there's options. If you wind up being in a situation where you're less than 59 and a half, you wind up separating from the company through your choice or the company's choice, you actually can still be in a position to use those monies and avoid that 10% penalty tax. What that takes, though, is some planning. And that's why we like to talk to folks early. Well, I mentioned earlier the cash flow analysis that we provide on a complimentary basis. Well, the reason that's so effective, it helps us to see these things and to chart them out a little bit. So depending upon whatever your circumstance is, your family, the amount of money you have set aside, the amount of money you need in retirement, we look at all of those things together, and it allows us to put together a plan that can work for you. It allows us to see, are you still in a position to be able to retire? What's going to be the best course for you to take? What decisions do you need to make? And that's what's most important. The money that you have for retirement, you want to use that money effectively. Of course, we're here to be able to help you to do that. If you have any questions about what we discussed, please feel free to give us a call, 800-900-5867, or you can shoot us an email at info@theretirementgroup.com. You can ask any questions you like. We can put you in touch with an advisor. Really, wherever you are in the country, we probably have an advisor close by, so we can have you talk to someone, help them, you can sit down with them and talk to them about your situation, your circumstances, and how the things we discussed here or other tax strategies might fit in your particular circumstance. The goal, of course, is to have a happy, successful retirement. We know that's what you want. We want that for you, and we're here to help you to achieve it. Thank you for joining us today.